Hello students, this is Professor Vincent Usaya. Welcome to my class. This is the presentation of part 1 of chapter 3, the adjusting process. Recall in chapters 1 and 2, in chapter 1 specifically, we talk about the accounting and the environment in which accounting operates in. And at the end of chapter 1, we created some financial statements or financial reports, as we indicated, that are used for decision making. Then in chapter 2, we talk extensively about recording business transactions, keeping track of business transactions, and at the end of chapter 2, we also produced or created a set of financial statements. And we said that we go about doing this by understanding accounting principles or accounting rules and applying them. Now, without you knowing, from chapters 1 through now, we have been learning step-by-step procedure of how to produce financial statements. In other words, financial statements are not prepared haphazardly. You have to take it one step at a time. You cannot perform step 4 until you are done with steps 1, 2, 3. So the adjusting process is one of the steps that we have to perform in order to prepare or produce our financial statements. Recall in chapters 1 and 2, we said that the most important thing that accountants do is produce or provide valuable information for different constituencies that they use for making a business decision. So information is a critical component of what you do. It is a big deal, as a matter of fact. So that being said, let's take a look at this step of the process of preparing financial statements. We said the adjusting process. Now, the question is, what is adjustment? Another name for that is update. So what are we talking about here? The adjusting process involves updating or adjusting some accounts that need to be adjusted before we prepare financial statements. It is important for you to know that. So adjusting, another word for it will be update or updating. Now, here is a common misconception that a lot of people have. By adjusting or updating some accounts that need to be adjusted, we are not correcting the account. The account is not wrong. Rather, we are just updating it. Now, the question is, if we don't do this, what is the ramification? Then the implication is we will wind up preparing inaccurate or incomplete financial statements. So if the financial statements are wrong, then obviously we are providing bad information to whomever is using the information. So that is the overview of chapter 3. So let's take a look at the objectives. Objective number 1, we are going to differentiate between cash basis accounting and accrued basis of accounting. We are going to talk about, obviously, the details of this objective in subsequent slides. We have 2, 4, 5, 7 objectives, but we'll be zeroing in on 7 of them. So let's take a look at the first objective. Here we are differentiating between cash basis accounting and accrued basis of accounting. Recall in chapter 2, I told you about the importance of making a commitment to commit to memory all these terminologies or terms that you are learning in this class. This is, accounting has its own language. You really have to understand the meaning of each term. So that being said, let's take a look at the difference between cash basis versus accrued basis of accounting. Now, these are the 2 methods for reporting revenues and expenses. We talked about revenues and expenses in previous chapter. Essentially, the difference between revenues and expenses will give you what? Net income or net loss. We used to call net income net profit. Okay, you don't have to take this class for you to know what that is. You know, people are in business to make money. And how do we know how much money you make? The difference between your revenues, how much you earn, and your expenses, the cost of producing the business. So let's take a look at what these two methods are saying. Now, let's quickly go through cash basis. Cash basis says revenue is recorded when cash is received, meaning we record revenue when we receive cash. If a customer pays us cash after providing services, we record revenue. If the customer doesn't pay us cash, we don't record revenue. Expenses are recorded when cash is paid. So if we don't pay cash, we don't record expense. If we pay cash, then we record it. That is what the cash basis of accounting is all about. Now, let's take a look at the accrued basis of accounting. It says that revenue is recorded when earned. So, irrespective of whether we receive cash or not, we record revenue. Now, let's back off. The question is, what is revenue? You recall in chapter 2, we said that revenue is the amount that a company earns either by providing services or selling goods. So let me give you an example. So I walk into a restaurant and I buy a meal for $10. For the restaurant, their revenue is $10 because they already provided me with the service, okay? So every company does one of two things. You are either selling stuff or you are providing services. So here we say that revenue is recorded when earned. So let's take a look at a CPA firm, an accounting firm. If a customer walks in and we provide services for the customer, whether the customer pay or not is irrelevant, we record it. Expenses, same thing, are recorded when incurred, meaning when we are obligated to pay the expense, whether we pay it or not, the company has to record it as an expense. Now, the question is, why is this important? Why is this important? Let me give you an illustration of cash basis and accrued basis of accounting. The last bullet here is the cash basis of accounting is not allowed under GAAP. In other words, cash basis is not acceptable. It is not generally accepted accounting principles. Accrued basis is used by most businesses. So at this point in time, it is very important for me to illustrate for you what are the difference between these two bases of accounting. Let's assume that you decide to start a janitorial business and you are going to cater for only the rich and the famous, and your first account was with Oprah Winfrey. So Oprah Winfrey said, well, I have a house in Chicago, I'm not in Los Angeles. I want you to provide a janitorial service on a monthly basis for $10,000. So that's your first contract. So listen to this. Listen to what happened. The first month or the first 3 months, you provided services. All right. Now, at the end of the 3rd month, take a look at what happened. The question is, how much revenue do you have? Now, for the cash basis of accounting, take a look at what happened. Oprah Winfrey is in Los Angeles and she's not available to pay you right away. All right, let's just stick with only 1 month, $10,000. So cash basis said, since Oprah Winfrey did not pay you, as far as cash basis of accounting is concerned, meaning the approach of reporting, recording and reporting revenues and expenses, cash basis said revenue should not be recorded, neither should it be reported. So it's zero. Let's assume that you have some employees and you pay those employees about $3,000 every month. So salaries expense is $3,000 and supplies, let's assume $2,000. So let's take a look at what we have here. So your revenue is zero You cough out $3,000 in salaries expense, you cough out $2,000 in supplies. So what do you have here? You have $5,000 net loss, all right, in the first 1 month. Why? Because as far as cash basis of accounting is concerned, revenue is recorded only when cash is received. Because Oprah Winfrey did not pay you because she's in Los Angeles, you don't have to report, you did not record or report revenue. Now let's take a look at the accrual. The accrual basis said, as long as the income or revenue has been earned, you have done the job, you have provided the services. Whether you receive cash or not is irrelevant. You need to record and report revenue. So in this case, it will be $10,000. Now, salaries expense remain as $3,000 and supplies remains as $2,000. So take a look at what happened. Here, you are reporting $5,000 in net income. So look at the implication of these two methods. If you show this report to the bank and you are interested in borrowing money, the bank is going to say, oh, the first 1 month you lost $5,000. But actually that is not true, because the cash basis is only saying it's strictly cash. Everything here is cash, everything here is cash. If it is not cash, don't report it. But the accrued basis recognize the fact that you provided $10,000 worth of services, even though you did not receive the cash right now, but it needs to be recorded, it also needs to be reported. So the accrued basis reflects the true picture of what actually transpired. So cash basis is not acceptable, accrued basis is. So now let's take a look at objective 2. We are going to define and apply the time period concept, revenue recognition, and matching principles. Now, recall in chapter 2, here we talk about the fact that we have a bunch of, one of the main things we are going to be learning in this course is understanding accounting principles or accounting rules and how to apply them in order for us to produce or create valuable information, financial statements that different people use to make business decisions. So here are some of the rules. Number 1, we have the time period concept. Now, what does that mean? Listen to this carefully. The time period concept said periodically, it could be monthly or quarterly, you need to assess how well you are doing in the business. How profitable am I? Am I making money or am I losing money? You cannot wait for a whole year, or you cannot wait forever before you make that assessment. So when you slice your performance and assess how well you are doing periodically, that is basically what the time period concept is all about. So we produce financial statements or financial report either monthly, quarterly, or annually. Another important thing that you need to know here is the fiscal year. What does that mean? Fiscal year simply means, well, as a matter of fact, let me add another piece to this slide. We also have what you call calendar year. So here we are talking about the accounting year of a company. The accounting year of a company is either fiscal year or calendar year. If it is calendar year, that means your accounting year is consistent with the calendar, January 1st through December 31st. So we call that calendar year. So the company is on a calendar year. Some companies are on what we call fiscal year, meaning 12 consecutive months other than the calendar year. For example, from July 1st this year through June 30th the following year. So we call that a fiscal year. So another important thing that I want to add to this slide is what we call the accounting period. What is accounting period? We are going to talk about this also in chapter 4. The accounting period simply talks about the frequency or the time period, same thing with the time period concept, that you slide into a segment to assess how you are doing. So the accounting period could be monthly, quarterly, semi-annually, or annually. In other words, how often do you want to do a time out and figure out how well you are doing? So that is the time period concept. And this is the end of part 1 presentation, and we will take it from here in part 2.